David Pierce, Director for Strategic Initiatives at GPS Capital Markets, joins us now as we get into this market picture a little bit more. David, before we get into a lot more of what you had put out as well in your notes, just wanted to talk about the banks, US banks versus European banks, and just your sense on which ones kind of are standing out for you right now in what is clearly a difficult market, where net interest incomes perhaps getting a little bit of a hit as well, some fatigue coming into play somewhat there too. Is that the sense you're getting?
Yeah, but I think that the European banks in general get more out of this interest rate rise than the U.S. banks. U.S. banks tend to have longer mortgages, for instance, on their books, and so they're locked into a lot longer term with the lower interest rate. So I think the European banks, the way that they structure mortgages there seems to be much more favorable for them than the U.S. banks right now. I think that the U.S. banks are kind of lagging a little bit compared to what's going on in Europe.
Yeah, it's just a fairly interesting one to kind of look at as well, especially in this market, high interest rate environment as well. One would think that with rates still remaining this high, you'd still get NIMs continuing to head higher. But I can see the change you're speaking about. If we just
Yeah.
move overall to this market as well, and this consumer demand in, that's kept on staying sticky as well for the market. How much does government spending have to play in this? And this is a conversation that I've had a little bit as well now recently. Government spending a lot more in the United States, that's surely holding up inflation.
Yeah, it really is, and it takes a lot of different forms. And we had a lot of government incentives. There's been a lot of government money going into the economy, and that just kind of churns, because it's we pay them, they pay us, and so there's a lot of still incentives going on for green energy, green vehicles, things like that. And we were having this conversation earlier today that really this all started back during COVID. COVID is what really put the brakes on the economy, and government started pumping money into the economy, giving people incentives. And that's really what started this whole inflation run that we have had over the last few years. So that's a big thing. And then you've also got, in addition to that, this is kind of inadvertently, but if you think about all of the, let's just take Ukraine, for instance. We're sending a lot of military infrastructure to Ukraine, sending lots of money to Ukraine. Well, that just means that the people that are manufacturing those kind of products are getting more business, and it's driving more business there. And so their employees have got more money. They're driving more money into the economy. And I agree with you. It's really something that the governments say that they want to slow this thing down, and then they pump incentive money back into the economy, and it's kind of a catch-22 situation.
Certainly feels that way. I mean, would a sticky surprise or a sticky inflation print surprise you, considering the strength of the U.S. economy and what we've just made note of with regards to spending? Or did the GDP numbers, and they dropped to 1.6%, as well as the jobs report, which was weaker than the market had anticipated, is that beginning to show cracks in these numbers?
Um, it is really transitory, because you have got so many things that are still really strong with the world economy, and then there's things that are areas that are struggling. I was just in Japan a couple weeks ago, and everything in Japan feels really, really down. It does not feel vibrant. It does not feel exciting. It does not feel like there's a lot of confidence in their economy. And from there, I went to Korea, and Korea is just on fire, and everything was vibrant, everything was exciting. And then I went to Sydney, and it was the same thing there. And I go to London, and it's everything's being built, and the same thing is happening here in the U.S. I feel a lot of vibrancy. When I go to mainland Europe, it doesn't feel nearly as vibrant. So I think that there's still a long ways to go. I think we've got a ways to go before we start seeing these rate cuts. I'm thinking November, maybe December, before we start seeing a rate cut. And Chairman Powell, he's pretty conservative, and he does not like to try to be ahead of the market. He really reacts to the market. And so when he's saying that they're there's no real rate cuts in sight. I don't believe that there really is.
Yeah, certainly an interesting one. Markets higher stateside, though, even hitting records again. The NASDAQ, we're seeing that mark come to fruition. But it doesn't feel like there's any major catalyst for a lot of these moves that we're seeing right now. And without a move lower in interest rates, does that bull trade continue then as well? Because there's nothing that will drive it forward, it seems.
Well, if you look at the U.S., let's look at the U.S. consumer. They are really still very, very bullish. And if you still go to car dealerships, they're having a hard time keeping inventories in. There is a huge demand for still buying products. Even though interest rates are higher, people are still buying houses. I was talking to a friend last night. Their daughter sold their house about a year and a half ago because they knew that housing prices were going to crash because interest rates were going up. Well, guess what? Housing prices didn't crash. And they're still going up, even though interest rates are going up. So it is a crazy thing to think that we've had so much interest increase and people are still consuming. It has not really made a huge impact. I think it has slowed the growth down, but it has not really turned us into a negative growth situation. There's still so much demand, and I think there's still going to be a lot of demand.
David, I just hope you're not still on Japanese or Korean time right now, because it is 2 a.m. where you are, and we appreciate you coming on this early as well for our show. Thank you so much for joining us.